Hey, everybody, welcome back. I'm reminded of one of Charlie Munger's great quotes: show me where I'm going to die so I won't go there. And what does that make me think about is the top reasons why most investors underperform the market. I'm going to give you 8 of them today. If you can think of others, please comment below and get ready because I want you, please direct message me, DM me. I want you to join my upcoming seminars in value and convexity investing. Let me give you the top 8 reasons why investors underperform. The first one, number 1, emotional decision making. Investors historically let fear and greed drive their decisions. When the market is euphoric, investors tend to get even more euphoric, right? You're paying up when others are paying up. When the market is overly pessimistic, that's when people start to get overly pessimistic. So emotion, watching a stock go up or down, is something that all of us are prone to. Few of us are able to put those emotions in check. What's number 2? Market timing. Market timing is another big reason why investors tend to underperform the market. If you attempt to time the market, if you follow news, if you follow different concepts that are out there that make you think you're timing some kind of macroeconomic turn in the market, you're going to get it wrong. You might as well flip a coin. Number 3, lack of patience. I wish it were easy, but patience is one of those virtues which many investors don't possess. And that's why those of us who can take a longer time horizon and not give up on investments too quickly, especially if the short run, if what we classify as the noise is disappointing. These are the people who overtrade. They frequently make mistakes. It's back to the emotion, right? They see a short-term mistake, they immediately try to correct it. A corollary to this, number 4, is overconfidence, right? So a lot of people, most of us are confident in our ability to pick a winning stock, or else we wouldn't be doing it. But often, and this often I find comes after a series of good outcomes, you start to get overconfident, and this leads to poor stock selection. What I would suggest in this, and we'll have corrections to all of these things, is focus on the process, don't focus on the outcome, right? If your process is consistent over time, the outcomes should work. But if you get overconfident because the outcomes are there, take a step back and see if you were right for the right reasons or if you got lucky for the wrong reasons. One of the big ways, number 5, that investors underperform is because there are high fees and expenses. It's not a secret that the business of running a casino does a lot better than the gambler, right? Las Vegas is not built on the winnings of gamblers. It's actually built on the losses of gamblers. So if you think of this as Wall Street, right? A lot of people treat Wall Street as a casino, and they're often surprised to learn that if you treat something like a casino, it's happy to take your money. So that's number 5, high fees and expenses. Also, pay close attention to what you're paying your mutual fund managers, and even for ETFs, right? I mean, one of the things that you should look at is the expense ratios of people running your money. Some people earn it, most do not. Number 6 is chasing hot stocks, right? So this is something which I've dealt with my entire career, even before my career started. The concept of a hot stock, you know what they are. We don't need to pick on them, Magnificent Seven. But the hottest stocks in the market are often the ones that people chase. The way you're going to make the money is being right on the undiscovered stuff. The real money is made in being patient, finding things that are undiscovered by the market, and then sitting tight when they become popular. And the number the number 8, and I'm going to give you a bonus. Ignoring risk management, right? What does that mean? Many people overlook portfolio risk, and I find it very frequent among even the smartest investors I run into that they don't hedge. They don't have an excessive fear of losing. I mean, there's never an excessive fear of losing. A warranted, rational fear of losing. In other words, it's often inexpensive to hedge a portfolio or to pay attention to the macro risk, for instance, and actually protect accordingly. The bonus is the short-term focus. Bonus answer: if you focus on short-term performance, if you focus on news, if you focus on the quarter, if you focus on the wiggles in the charts, this is where you will underperform. Very few people are very good at following the news and making the appropriate reaction in their portfolio, and that's why there's high turnover, because people believe, back to overconfidence, that they can do it. So these are many of the reasons that I've just listed, and we're going to talk in detail about how you can correct these if you have any or all of the above problems that cause you to underperform.